Well, good evening and welcome to this live stream on the 3rd of October 2023. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. Thanks for spending some time with us. I have Damien teed up ready to come in. And just before I do that, let me, as I always do, remind you that we don't provide specific advice, neither financial or legal advice. It's a general conversation only. We do moderate the chat room, but feel free to throw your comments in. And I don't necessarily follow all the conversations, but always worthwhile to read what people are thinking. This is as of the 3rd of October, as I say. And if you'd like to get my attention or ask a question, if you use @WalkTheWorld, that'll go to my queue so that you can actually see what I'm up to, and means I can also make sure that your question gets the attention it deserves. And I've enabled Super Chat, which means that if you want to get your question top of the list, you can do that, or make a contribution to what we do here. Always greatly appreciated. Helps to cover some of the costs of what we do. Anyway, with that out the way, let me push this button and bring Damien in. Damien, hello. How are you doing?
Very well, very well. Good to see you, Martin.
Yeah, indeed. Fun times. There's so much going on. And I remind people that, of course, September and October are actually the most wobbly times in the year for the markets generally.
Yes, absolutely. That's it's in the past. That has been the case. Yes, there's always lots of different things that people have in terms of what they're looking at various seasonal effects and stuff like that. And I think some of them, for me, I can definitely see the case for, especially a lot of the sort of the sort of flow-driven ones about end of tax years and what people are doing in terms of up years and down years and tax loss selling and all that sort of stuff. Sometimes some of the other ones become a bit more esoteric, though. So yes, but in the past, September and October have been wobbly, and we obviously had a not so good September just passed.
Yeah, the markets were somewhat down over the month, although still up for the start of the year. Gold was down as well a little recently, and I guess the starting point for all of this is there are two. One is what the RBA did, so let's cover that first. But then also let's talk about the bonds, because I think the question of the bonds and what they're doing is probably the biggest question out there. And strategically, it's pretty important to understand, again, from an investment perspective, but also more broadly in terms of what reserve banks around the world might do because of it.
Yeah, that's right. And what was interesting or what's certainly been interesting over the last week or so is that for a lot of September, we went through this phase where bond yields were rising, and we saw the Nasdaq, in particular, falling away, and a lot of that, this discussion about, a lot of the growth coming from some of these the 7 big stocks. Basically, if you took out the 7 big stocks, depending upon which measure you're looking at, basically says that you got no growth from the rest of the stocks or something like that. I think there was a conversion of a version in which looked at the Russell 2000, which is a small cap index in the US. Basically, I think it's all stocks between the 1,000 and the 3,000. But anyway, so if you had gone long along those 7 and short that, I think you'd be up about 180% or something like that was over over this period. Oh, sorry, maybe 87%. You're 187. If you started at 100, you're at 187. Sorry, it wasn't 180. But yeah, it's just been dramatic outperformance of those stocks. And so you would have thought. Yeah, but sorry, where I was getting to with that, before I sidetracked myself, was that within the last few days, it's actually we've seen a little bit of both, like a little bit of those stocks coming on themselves and not really being affected by those rising yields. And I guess the argument for those yields is that, look, these are high growth stocks in the long term. So if yields are high, then when you put them into your valuation model, you come up with a lower value. And so it's been a little bit. We've certainly been through some different trading in the last few weeks.
Absolutely, and the mantra that I'm getting is quite strongly higher for longer. So central banks more likely to keep rates higher for longer. And in fact, there's a couple of economists in Australia have come out now and saying, the RBA won't be able to cut until 2025. Whereas previously they were saying early 2024. So that's a significant change. And they're saying similar things in several other countries now. So again, if you think about, there was a time when everyone was thinking that the US is going to recession. No, then it's not. Then it's going to actually have a soft landing. And then, we're back now with some people suggesting even in the US there might be a recession, a mild recession next year a little bit. But rates remaining high. And Jerome Powell's recent outings very much in line with that. And then the RBA, of course, which announced their decision today, no change, no surprise there, I guess, change of governor, but no change of policy. And in there, I would say it's a bit of a bullish hold. In other words, they're still potentially leaving open the window for higher rates, maybe next month, maybe. And of course, we have the quarterly inflation numbers at the end of this month. So that might give them a little more reading. The monthly reading was up a little. The headline.
Yeah, Australia's a bit.
So it's a bit weird.
Yeah, Australia's got that problem. Yeah, and it's got the problem. So you've had the falling currency, which increases inflation a little on your imports. We've obviously got oil price going, spiking significantly higher, and then the Aussie dollar adding more to that. We've still got the energy prices sort of flowing through, and now house price and rents in particular. As we flood the market with more and more immigrants, and sort of record level. Sorry, that's the wrong way of saying it. I'm certainly not being negative against immigrants. So what I'm saying is, I think immigration is a great thing, but I think you can obviously have too much of it. And what we're doing at the moment is we're running, never seen before levels of immigration, and wondering why rent prices are going up. So I've actually got a chart up, a Bloomberg one, just showing soft landing and hard landing mentions in newspapers.
Yep, it's showing it now.
So so you can see in 1999 there was a lot of mention of soft landing before the recession happened, and in 2007 again, lots and lots of mentions of soft landing, and then and then obviously we went into the one of the biggest recessions the US has ever had. So I guess where I'm getting to is it's not atypical to see lots of mentions of recessions coming through, of soft landing coming through, and what typically tends to happen as well. And it's not to say this is you can't guarantee this, but it does seem in most recessions, as you're getting close to the end of it, close to the start of it, is where economists start talking about saying, actually, maybe we've sorted this out. Maybe there isn't going to be a downturn, and maybe there's I don't know. I guess some of the worst of them are things like Ben Bernanke sort of saying subprime risks look like they're contained, and there's 100 other quotes from various people just before sort of peaks. I think it was Galbraith just before the Great Depression, saying that it looks like stocks have reached a permanently high plateau or something like that. And so there's a long history of people sort of So it doesn't mean that when somebody says that is going to that's the case, that the opposite will happen, but it certainly has a lot in the past.
Well, and I guess, of course, there are so many variables at the moment, right? I mean, the very high bond rates, I think, are very significant. If you look out across the yield curve, it isn't just the near term now; it's pretty much across the curve. And we're looking at higher bond yields. Higher bond yields. Remember, the price and the yield is inverted. So in other words, bond prices have dropped dramatically, and in fact, quite a few large financial institutions are holding bond portfolios now that are worth a lot less in terms of the price of the bonds. And by the way, one of the other observations there, people keep throwing up the chart showing Chinese investment in US treasuries is down. No. It's not that they're investing less. It's more to do with the fact that the value of the bonds have come down because of the price drops.
Yeah, well, that's part of it. But the other thing, who's the guy? Brad Setzer is I can't remember his exact position now, but he's sort of been heavily involved in the government over there, and he does some excellent work on trying to track it through. And his stuff, when he digs into it, basically says, it's the official holdings have fallen a little bit as well. in terms of what they're investing, but that's mainly because they're investing through all these different middlemen. And so he tracks them through, and you look at sort of, there's places like Liechtenstein and weird sort of small countries that have all of a sudden got these massive holdings of US debt, which so he tracks back through to Chinese debt, just sort of hiding behind various financial structures. And so so I sort of take a lot of that with a grain of salt. Whenever I see those, I always go and check his ones, and he's usually saying the opposite. He's going, actually, it's just they're investing. They're not investing their own name. It's through 3 different shell companies or whatever.
But what do you make of these bond moves, and more importantly, what does it do for a investment portfolio?
Yeah, so look, there's a couple of different things that come from it. So one is on the investment. One is, I think the first one we need to talk about is the whole recession. What does it mean in terms of recessions and financial conditions in terms of tightening? So it's worth noting, particularly in the US, this has meant that the rises we've seen recently have meant that mortgage rates are now up another 0.5% in the US. So despite the Fed not raising rates, because so many people lock into the long-term rates in the US, we've effectively seen the price for housing increase. It also affects the price for credit for companies. Now, companies manage to lock in lower rates as well. So what happened in the US is that US households managed to lock in lower rates by and large. And so a lot of them are sitting on these 30-year mortgages that they just don't want to get out of anymore. And it's sort of got to the stage where the amount of new houses coming onto the market, the amount of existing houses coming onto the market is really low, because these people have locked in mortgage rates at whatever 3 or 4%. And if you want to move house, then your new one's going to be at 7%, and your 3 or 4% you locked in will cover you for the next 30 years. And so there's these people going, well, I really need that extra bedroom, but maybe I'll just stay where I am because I don't want to give up my mortgage. So there's that. And then the other part is the companies manage to extend their durations by about 2 or 3 years on average. And so what that's meant is that the actual impact of the rate rises has taken longer, but that will, now we're just looking at higher rates again for corporates that are rolling over debts. So there's an economic point, I guess, in terms of the higher rates. What does it actually mean? And then there's the part. There's potentially some issues around. Are there some more banks out there that have got their hedging wrong, similar to Silicon Valley Bank? I don't think it's going to be as widespread. I mean, I think at the margin, it'll make a little bit of a difference. There's companies out there with treasuries, banks they'll just won't be able to lend as much. But lending's already in the tank for that. Like, lending's already well down in the US, and so could there be another blow up? Sure, there could be, but I think we've had 6 months to try and get your hedging sorted, and I don't think anyone's going to be caught by surprise this time around. And then we saw similar in the UK when the gilts sort of shot up, earlier on the year, and the UK central government had to step in. Sorry, central bank had to step in to sort of get the market going and clear. Is that I think that now, certainly, if anyone's going to have problems now, it'll be because they actually did have problems 6 months ago and just managed to hold on, and now so this next batch is the straw that's breaking the back, and they're pretty close to falling over anyway. So yeah, so net effect is I don't think that's going to be as big of an issue. And then for investors, it's always an interesting one with these. So the 10-year bond rate in particular is saying, when people focus on the 10-year bond rate, and what you've got to remember with that is, if you are going to get the 10-year bond rate, you got to keep, that's a trader's line, because you got to keep buying and selling. So if you're saying, oh yeah, I've got a 10.5-year bond, and now it moves to 9.5-year bond, and then I'm going to go stick it back on the other end, and then do that again and keep cycling it through, then you're genuinely going to make losses within that when you're doing that trading side. If, on the other hand, you're looking at a bond portfolio that you've bought to hold to maturity within a diversified portfolio, it's much less of an issue, because and this is why they changed the banking rules for that. Is you go, okay, I bought this bond for whatever. I bought it for $110, and it's been paying a 5% yield. And so the idea was over the next 10 years, when yields were 4%, this thing was paying a 5% yield. And so it's worth $110. I bought it for $110. I'm going to get back $100 in 10 years' time. And so I'm going to lose $1 every year, and I'll get $5 in distributions, and the net effect is a 4% yield that I'm sort of getting for that. So now we've got a 5% yield. So what that means is your $110 comes back to effectively $100 for that. Now, if you were going to hold this thing and you've got it for the yield anyway, then actually the value isn't a lot of, it's of academic interest, and you're certainly interested in case you want to sell the portfolio. But if you weren't going to sell it anyway, you're just looking to have that steady yield, then it's really not making as much of a difference to your portfolio. So yeah, it depends on how you're holding. If you're holding them as trading instruments, absolutely, it's having a negative effect. And the longer the term of your bonds, the more it will have an effect. So if you've got short-term bonds of a couple of years, then it really has very little impact, these types of moves. You might be talking about 2 or 3% change in the value of your bonds, if that. And that's whereas the longer the duration, so if you're buying sort of 30-year bonds and stuff like that, you can get some pretty decent sized moves in those. Might be a 5% move, or with the types of if you get a 0.5% move in yields, you can sort of get a 5% yield, or some of the longer dated ones, even a 10% change in the value of the underlying price. So if you are trading, they can sort of give reasonably big returns. Having said that, 10% move obviously is in relative to the stock market is not heaps for a stock. Stocks can easily do that in a day. Why do the bonds get so much attention? And usually because it's a lot of the traders out there are using lots of leverage, and that's where some of this danger comes from, is because they're all levered up on various trades, and so sometimes if they get caught on the wrong side of that, it was only a 10% loss, shouldn't have been enough to cause major problems. But if they were levered up to 10 times, they had $1 worth of equity for every and $9 worth of debt in the trade, which is not uncommon for some of the hedge funds, is that that can then start causing some serious problems.
Yeah, and there's a couple of words that have come into the commentary quite recently. One is the duration trade. I was thinking, should you go longer because of the fact that rates have gone a lot higher? And then the other is the difference between, as you say, trading and holding. And I guess the bottom line for me is this: I always think that there has to be some correlations between the average returns on bonds versus equities, or the whole market would go one way or the other. So by definition, there's got to be some similarity between the two. I mean, is that me being naive, or is that true?
Well, it's traditionally been somewhat the case. Yeah. I mean, you do get divergences, and they talk about the stock guys talk about the bond guys as forecasting whatever it is, 10 out of the next 3 recessions type of thing, because they're always jumping at shadows, and it's always like things are going to be terrible. And the bond guys talk about the stock guys as being the idiot brother type stuff, and always the glass is always half full, and even when it's empty. So I think there is a certain element to that, and actually that flows back to one of those comments I was talking about to you earlier about there's this real divergence in the way markets are looking at forecasts at the moment. So in terms of macroeconomics, you usually rely on a lot of surveys, what they call soft data. Is all this surveys, forward orders, all these expectations and things like that. And people make all these indexes based on forward-looking surveys that have happened, and they all look terrible. By and large, they're all sort of at recessionary levels or worse, and that's why sort of economists have been saying, this is going to be, we're expecting a recession. The actual data has been okay. Like, it hasn't been, it's not great data, but it's been, when you look at GDP growth and you look at employment in particular and a whole bunch of other factors, the actual data has been all right. So the question is there something different going on now where these forward indicators that in the past have been pretty reliable are no longer as reliable? The stock market's almost exactly the opposite. So you look at the actual results, and we're clocking in sort of negative 5% EPS growth for the last few quarters. It's about to go, the stock markets have it going to zero for third quarter, going to 5 or 6% for the fourth quarter, and up to 10 into next year. And so it's actually exactly the opposite. Where one saying average current actual data, terrible forecasts, and the other one saying exactly the opposite. So in the past, it's usually resolved in the way of economics or the economic stats, but that's not always the case. So I think I'm more comfortable with that as a view. For me, is that I do think the economic forward indicators are giving us a better lead as to what's going to happen. And if that's the case, and those do come through, and we do go into a downturn, then bond yields bonds are a great trade at the moment. So I'm sort of kicking over whether I extend the duration. I sort of feel, certainly as they close in on 5%, I think I'll certainly lift my duration a little bit just to try and get a little bit of a hang for that. I mean, I think of the way I think about my bond portfolio is there's a sort of a part that's there for yield and effectively the ladder. Is it, you have bonds, expiring every year, and you just stick it back on the other end of the ladder, and you sort of roll through those, and you get a yield from it, and it helps keep sort of income coming through into your portfolio. And then around that, I might then go and add extra, the long end or the short end or whatever it is, depending upon whether I'm looking for safety or looking for yields to come down. And at the moment, I'm seriously kicking it. I've sort of added a little bit. And I'm seriously sort of considering whether to keep topping up on that at the long end.
Yeah, it does make it very interesting. And of course, there's a lot of debate about how high can bonds go, and it's worth just thinking about the US a little bit, because of course you've got the Federal Reserve effectively putting bonds back into the market. In other words, they're doing the reverse of what they did previously, which was buying everybody's bonds. And you've got the Treasury in the US issuing masses and masses and masses, right, to try and support the economy, trillions, and we had the shutdown that didn't happen. So I guess one of the things that I'm thinking is that maybe some bondholders are saying, well, I need to actually see a higher return from my bonds, because there's actually now more risk. Even in the US, even with everything that's going on there, because of this weird thing. And of course, a couple of the ratings agencies have actually down-rated the US because of the risks, and they actually point to the size of the debt, but also the inability of the government to manage itself, right, as another factor. Well, and if you argue that the US is the best dressed economy, we can debate that or not. But if they're having a problem there, what does that say for some of the other economies?
Yes. So a few things to unpack there. Certainly. The government shutdown and kicking the speaker out and all that type of stuff like that is the US is obviously in for more political issues over the next little while, and I would say that that's ramping up, and genuinely, I think for the people who are very involved in the politics side, and certainly within the court cases, look, there's been a string of defeats in all the Trump court cases. Effectively, it does look like from his behaviour today is that he's now treating these court cases as part of his campaign, as opposed to it's almost as if he's resigned to losing, and so now this is just part of his campaign to I guess drum up as much outrage and everything as it goes along, and so I would say as much as possible there will be, he's going to be trying to cause as much issues as he can. And, if the US does end up in recession, particularly into the new year, and if they can help, if it can be government or if it can be political stalemates and things like that that actually help push the US into recession, I think Trump would take that into the election as a look at this. Biden caused a recession, regardless of whether it was coming anyway or Trump helped cause it or whatever it is. But it certainly pitched that story, and it could be. I think that's potentially the way the Republicans see the next election playing out, if they can cause as much problem now as they can. So, I guess it's uncertainty there, lots of uncertainty.
Well, they're running interference deliberately, aren't they? And it's worth also just highlighting the strikes that are going on over in the US, particularly in the auto sector, right? I mean, I think these are very significant because it's fascinating how it's being played. The Republicans and Trump is saying, well, electric cars are bad because actually they don't actually give you security of tenure, and and you're going to be using batteries from around the world, etc. Whereas Biden is arguing a different line there, but it's become a really big and significant factor, and I guess it's for me is a leading indicator of some of the trouble below the waterline.
Yeah, well, and what's interesting is that if you went back 10 years and there was an auto strike going on, both sides of politics would be on the whole, you need to be more responsible, and maybe you should get higher wages, but you shouldn't go on strike to get there. Well, certainly that'd be your Democrats were sort of towing like the sort of corporate side of it, and the Republicans would have been dead against it as a sort of as a general rule. Whereas now we've got both parties sort of vying for the vote. Both parties are sort of saying, we're on your side. We've got, and so will that spread to other sectors? Could you see another burst of inflation, wage inflation from that? Maybe. I guess the thing is the unionization rates are so much lower now than what they were, when we were worried about cost push inflation in the 70s, say. But is there a potential for another wage burst? Yeah, maybe. And I actually think though that's going to come at the expense of companies as opposed to adding lots more to inflation. I think that's more of a take the auto workers as a great example. China is busy trying to export as many electric vehicles as they possibly can. They're sort of driving their, went through a price war in China and still going through a price war in China, and now trying to export those cars elsewhere and having a lot of success. And so can those, if they put through a 30% wage rise or a 40% wage rise, whatever the end number is that going to go into higher prices, or is actually that just going to be the companies are going to have to wear that, and that's going to have to come out of the profit margin because they can't sell cars for cheaper because China's trying to undercut them.
Yeah, absolutely. And the interesting debate here is the wages bill, because there were some settlements in the US which were quite high. Some of the not just a little bit above, but way above the inflation rate. So the wages story is definitely one to watch, but I do think it's the political side of the coin which is the most interesting, and the fact that Biden was on the picket lines and supporting the workers, I thought was quite fascinating. Who'd have thunk it? Yeah, well, that's right. But I think so. I mean, the numbers sound really big for the wages for the because I think the unions were going for 40%, and they were offered, but that's over a 4-year period, and also they were already on some quite significantly lower rates that sort of ran into the inflation burst. So I guess it's sort of, some of it's a makeup. Probably 10% of that's like making up for wage rises that didn't keep up with inflation over the last couple of years. And then
and then the other 30%, and so 30% over 4 years, sort of like 8% per annum, which is significant, obviously, but it's or a little bit less than that, but it's not. It might not sound as it's not as bad as the whole 40%. When you hear 40% wage rise, it sounds shocking, but there's a chunk of it to make up for lost wages in the past. So, but yes, and the corporates over there. Car companies are as profitable as they've ever been. Well, maybe not as they've ever been, but certainly they're way more profitable than they've been any time in the last 10 years. On the back of not being able to produce as many cars as they like and shortages, and so they've managed to jack the prices up. But that's all coming to an end, and so yes, it will be I don't think that one in particular is going to end up. Much of it's going to end up in inflation, but time will tell.
Well, we've talked about the US. Let's talk about China for a bit, because, of course, China is still struggling with some of the ongoing issues. But there is a very important discussion point here, which is often overlooked, and that is, some of the underlying data out of China does look a bit, concerning.
Well, I've got a chart up just of the one I show every month, which is the two different ways to calculate Chinese housing starts. One of them is what are they actually saying, which is the blue line, and that's down, I don't know, more than 50% from its peak, and still falling. Every time we get more data, it still looks worse. And then the orange line is a line which says, because the numbers don't add up in China, and you're out by billions when you look at the starts versus completions and all that. The orange line is saying, well, what happens if the completions numbers are right and the under construction numbers are right? What would starts look like? And that's fallen by 70 or 80%. That's sort of really crashed. Now the other thing we got out was some more forecasts in terms of urban population, and this might not look that bad in terms of the grey line here, which is sort of showing for 10 years there, you had like 20 million people a year urbanizing, and it's fallen off for the last few years, and it's just sort of going to keep trailing off is now the expectation from this is from the IMF, the International Monetary Fund. Everyone else's forecasts until now have basically had this bounce back. Was that China, it was 20 million plus, and it had fallen because of COVID back to sort of 15 million or below, but it was going to bounce back, and it was going to be back at 20 million. And we've seen some updates to some of the statistics in terms of the births, which has been downgraded as well. And so the types of levels we're looking at, you could cut even more out of the housing starts and still get back to sort of and still not have to worry about running out of housing. So the housing stats are looking terrible. Some of the other ones are looking. There was a slight bounce back, I guess, this month. Not to like good levels, but just things weren't quite as bad. But I do think the housing is where it's all at. And I've run through on past shows on this, but I guess the message I just want to send to people is, you hear about Country Garden, you hear about Evergrande as being these two big players that have both got these serious problems and are defaulting on debts. Is that when you look at the top 20 developers, that these are just two that look so similar to all the rest of them. They've all got heaps of unsold property. They've also got properties that have been paid for, but they haven't actually built yet. And why is there a difference between that? Well, they've sold whatever it is, 20 or 30% of the houses, say apartments, say in this new apartment building they're going to build, they've already pre-sold. But when they finish it, they've still got to sell the other 80 or 70 or 80%. So And so that they've got this part where, all these unsold apartments sitting in one side and all these ones that have already been paid for that haven't built yet. They're all way late on paying their suppliers. It's about 6 months on average in terms of paying suppliers and staff. They've all got, for every dollar of equity, they've got $9 or $10 worth of debt. It's just every single one of them looks insolvent from any normal sort of assessment of all those ratios. The difference is they're all backstopped by the Chinese government, and sort of been basically been told to keep going, keep letting them build. They've got to finish building the ones that they've already been paid for, and then who knows what will happen after that. I wouldn't be surprised if it's basically let them keep going to build the existing ones, and then let them fall over at some point. So yes, property for me is where everything is at in China, in terms of China.
And just worth underscoring, some of those property companies also have provided other financial products to individuals too, right? So there's actually a broader wealth problem as well as just the pure property problem. And it's interesting, quite a few Chinese people have multiple properties, so they're an investment class as well as for living in. And they've also got other investment assets wrapped up into these companies too. So it's obviously, if they were to go pop, it would be difficult, to put it mildly. Yeah. But interestingly, Evergrande shares were suspended last week because there was a rumor about some illegal dealings. But it's now back. And in fact, the price went up again. So
yeah, that's right. Well, when they say the price has gone up and things like that, the share price could double and you're still going to be down 90-something%. It's a lottery ticket now. It's like, well, will they manage to sell some of these things for more? Yeah. Anyway, I think there's, and that's part of the issue, I think, in the whole why so many people own property in China, because they really haven't had too many other savings mechanisms, and the share market has been a bit of a lottery and a bit of a casino. And so, that's been the obvious place for people to put money, is that they can, we can buy more houses because we're allowed to. And I think the ownership rates in China are 90%-ish in terms of people owning their houses. So, that doesn't leave too many people having second houses. And there was this one of the ex-statisticians came out talking about, he thought they had enough empty houses basically to house China again effectively. So he's came out sort of basically saying that the stats were just way over. They just had way too many houses that had been built, and they could just there was no way they could possibly ever fill them.
And it's interesting that some of the Chinese property situations are actually impacting Australia too. There was I made a show the other day talking about a development on the Gold Coast, which was actually a Chinese developer who's not actually actively selling the properties, he's holding them at the moment. And I know several others where Chinese developers in Australia have actually receded and gone back because of the fact that they were being impacted by what was happening up in China. So this China property thing is not just necessarily impacting China, but it's a broader conversation, I think.
Yeah. Well, I mean, it is I think it's the biggest asset class in the world. Like when you add up the value of Chinese property, I think you get to 60 trillion or something like that. It's because there's so much property out there, and the other thing in terms of China is that demographic issue, and so that's the part where, because you've had one-child policies in China for so long now, we're looking at a significant drop in terms of the number of youth that are available. And I think if you go through various different groups now, there's more 40-year-olds to 40 to 50-year-olds than what there are 30 to 40-year-olds, and there's more 30 to 40-year-olds than 20 to 30, and so far down. And so, and one of the issues is that the people you really want, people who really spend in terms of consumption, is young people. And so if you're looking at China and saying that the hope there is that consumption is what's going to bail them out, then demographics are very much working against you in terms of that. So I think you'll find that the other thing you find is that the sort of Michael Pettis, who's a quite a well-known economist who looks at a lot at China, has this discussion about saying, well, China is more imbalanced than any country's ever been in terms of the household sector. Usually makes up 70%-ish or more of an economy. In China, it makes up less than 50%. And so they need to actually transfer more across from the government and businesses across to the household sector. And effectively, the household sector has been subsidizing the business and government by giving them cheap loans and that type of thing. So you need that to rebalance. And China really doesn't look like they're doing anything to try and rebalance that. And because of the demographics, they're naturally sort of drifting in the wrong direction.
Now, one of the interesting questions I've got for you is, what about some of the other industry sectors? So, we've talked quite a lot about the manufacturing, particularly auto manufacturing. The tech, of course, is a boom, but there are other industry sectors. I was reading something the other day that maybe shipping is something which is worth thinking about. You've done some work on that, so that was a quite good timing. So it's worth talking about that.
Yeah. So the theory behind this is that I'm worried about the US going to recession and the sort of downturns you get and share prices falling. And so I'm trying to work out within equities portfolios, where do you go for safety? And one of the places that sort of immediately springs to mind is, well, let's go and find sectors that are leading and sectors that are already in recession and see if we can find some stocks within that. So I sort of grabbed the logistics sector as a good sort of microcosm, and I'm going to pick on the shipping sector within that, but it's sort of largely true. The same types of factors as you look through the different sectors. So if you sort of look at that, and on one part we're saying, okay, we've got these changing supply chains in that the US is importing more from a lot more from China and a lot less from China and a lot more from Mexico. So that's sort of making a bit of a difference to where it's coming from. You've got within this whole sector as well, is that it's sort of the initial inclination is, oil prices have been rising. That's going to be a bad thing for logistics companies and companies in the transport sector. It actually works out the opposite way. This is just an example of the price of diesel per gallon, and then the variable cost per mile that you get. And so it's actually an upward sloping line. The higher the oil price goes, the more companies get to push back on their customers. So you see the fuel surcharges, for example, that airlines come up with when oil prices go high. They're quick to put them on and slow to take them off. And if you do the calculation, sometimes they're a reasonable amount higher than what the actual change is. So that's sort of ticking the box in terms of saying there's positives. If you look at shipping rates, they're pretty much back to normal now. So this is a global look that's sort of, and you can see that massive peak we went through where they basically went almost 10 times higher, and then that's all come back down. So this is that's your spot rate. So that the rate that's being charged to people who haven't sort of booked in for longer periods of time. The issue though is that when you start looking at companies, and I've got here a Maersk, which is one of the biggest sort of European Dutch liners that does a lot of container traffic, is that earnings, while they've gone up and come down, they're still actually not too bad in terms of that where they are. That sort of that blue line's the last 12 months of earnings. So, and the reason why is because a lot of people sort of panicked and tried to locked in rates when the rates were higher. So you used to ship things at $1,500 a container. The rates went up to $10,000. People panicked and were like, if they go to $20,000, then I'm not going to be able to afford to send my stuff anymore. So I'll lock in for a year at $10,000 or whatever it is. And so that's what's the companies are still sort of. That's still coming off out of the forecast. So that's one factor. The other one is that because of this boom, we just saw everywhere capital expenditure in that whole logistics sector, whether it be new systems, upgraded ways to communicate with other companies, whether it's supports, whether it's rail lines, trucking, whatever you looked at, you just saw the masses of capex trying to clear these chains. And so this is I've got a chart up just showing container ships, the amount that have been ordered and being delivered. So you can see that we've got for 23 and 2024, it's just never seen before levels of new ships coming through. And so there's, I think over the next 3 years, you're getting maybe it's close to 30% of the current sort of installed base is being added. And so what that means is probably deflation, more deflation within that. So, so the net effect when you look through that sector is you end up going, okay, well, the earnings are still better than what they'll probably revert back to. The outlook is that, the prices have reverted to where they are, but we're still yet to see the effect or yet to see the full effect of all that spending that's happened. And so there's actually going to be more competition within that sector, chasing prices lower probably. So the net effect for those is like, look, I'm still interested in it as a sector and trying to work out where the bottom is, but it feels like we're not there yet. And that's sort of as I'm digging through a few different sectors, that sort of seems to be the case. At the other end, you look at sectors that are probably going to be a bit more. You probably see a little bit more growth in, and one of those was we had a guy on last week on the podcast, security, looking at IT security, and so that's this interesting part where. We've obviously seen the hack of Bupa, Optus. There's been a number of other ones. Latitude got hacked. We saw even a few years ago the tech darling Canva, which people have probably forgotten about already. That got hacked in a quite a serious hack of its customers. So it's happening to a lot of companies. What does that actually mean for the companies involved? It does seem as if the effects are fading relatively quickly. We actually bought a little bit more Medibank when it fell, with a view that it wouldn't be it looked for them less about more about being sort of unlucky-ish and as opposed to having particularly poor sort of IT policies. The hackers did quite a good job in terms of getting around their systems, and so the question is, there's a couple of different questions coming out of it. One is, now we've got better AI tools for the hackers. Does that mean they're more likely to get in? Now that we've got things like most people would know that whole phrase that in Australia, my voice is my what is it? Well, I've now forgotten it. Whatever you say to the ATO, my voice is my identity, or something like that. And but that's no longer the case. There's plenty of websites out there where you can download people's voices and then upload or tell it what you want those voices to say, and it comes through in a particularly sounds just like the person who's doing it. So you can no longer sort of rely on those factors. And so it seems as if there's a lot of sort of crumbling factors in the whole security side. And so we sort of had a decent look at that. Now, things might not look as bad as I guess the headlines read, but they still look like there's going to have to be a lot more money spent in this sector. And so that's where I've pulled up here a bunch of different companies in that sector. We run like a tilt on some of our, so clients can basically choose to have some extra IT security companies. And these are the types of companies we're throwing in there. So, a mix of ones between your sort of, the sort of general security as a service type ones, things like Palo Alto Networks, Fortinet, CrowdStrike, Zscaler are all ones that sort of have this more general technology of a mix of different solutions and software services that they'll have. But they're all expensive. And so they're all on sort of 30, 40 times earnings. They're all forecast to be growing at sort of 15 to 20%, and so it's this real story within that of going. They've got these costs. They've got this great history of growing revenue. Almost all these companies have got these long sort of great history. And the question is, can they constrain their costs while their revenues sort of, go up by 30, 40% over the next few years? And if they do, then these things will stop looking expensive and they'll start looking cheap. But if they keep letting their costs run at the same rate as their revenues, then they'll probably still look expensive. So so it's an interesting story and trying to work out which ones of those match. Some of the ones that even, you can pick out some names there that look a bit cheaper. So Checkpoint, for example, looks, that's sort of trading on market multiples. The issue is they're sort of seen as a real laggard in that market, and some of the older technology. Akamai is they do a lot of CloudFront type thing. So basically it's distributing people's websites to local places, which helps against denial of service attacks. But they've got a little bit of an issue in that they're not as scalable. So if they want to double the size, they're probably going to have to double a lot of their costs as well. And so which is why they also don't trade on a high multiple. And then the last place you can sort of get for these ones as well is, or one more place you can get from it is places like Booz Allen, that's sort of consulting effectively, saying, yes, companies are going to spend a lot of money in consultants. A lot of those are unlisted. So, your PwCs and Ernst & Youngs and things like that, you sort of can't get exposure to, but there are a few listed research consulting services. And then there are a number of other companies out there that have really big security divisions, but they're just part of another company that's so large that they just sort of pale into insignificance. So I think Microsoft, for example, it's got a big security division relative to all these other security players, but actually is relative to what else Microsoft makes, it's not that big. And that's also true of Broadcom and Oracle as well. Sorry, not Oracle. Cisco as well, sort of sit in that same market as having, massive security divisions, but they might only be 10% or 15% of the overall company. So not really going to make a difference. So that's another sort of one more area that we've been looking at over the last few weeks.
Yeah, very interesting. And it's worth just underscoring again, isn't it, how distorted many markets are with the technology sector doing so much of the heavy lifting, while the rest of the market, I mean, even in the US, the rest of the market's gone backwards. That's a really important thing. And I guess there's two questions. One is, can the technology sector continue to go higher, or was it actually overvalued? In other words, the future expectations just go out of hand with AI, et cetera, or is it true that there is actually real long-term value there relative to the rest of the markets? And if you were to strip out the technology element from the markets, the story in the US would be quite different. The story in Australia, of course, is not very strong relative because, of course, we don't have the same technology base that the US has.
No, that's right. So I've got a chart up of world EPS growth where I've taken the top 500 companies, and hopefully it's big enough to see. But the top chart is basically showing how much of world EPS growth comes from the US big six technology stocks. Is the first line, and the second one is the first bar. The second bar is how much comes from the rest of the US. And so basically, for Q3, we expect analyst forecasts have basically got 0% growth, or 0.2% growth, and that comes from 4% of that comes from just those six stocks: Nvidia, Alphabet, Microsoft, Apple, Amazon, Meta. So if you look at just the growth from those, you add 4%, and then every other company takes off, all that stuff till you get back to 0% growth. And so that's what's expected in Q3. So really strong growth. Even stronger growth for Q4 from those same companies. So they're almost going to grow at 6%, or sorry, not the companies themselves are growing at sort of 15 or 20% or greater. What I'm saying is they will add, almost 6% to the world. Just those six companies alone will add almost 6% to the world earnings per share growth. And then all the other sectors are basically expected to do nothing. So you end up with, a very slight negative. So you still end up with, that 5 or 6% growth for the whole market. 2024 is a different story. There is broad-based optimism. And so, those companies are only expected to add 2% to the world growth, and then the world's expected to grow at 10%. And this is part of the reason I've sort of been digging through these sectors as well. I'm trying to find out, where's this 10% coming from? Am I missing something? Is there something that's some underlying trend that's just like there's a cost savings, or there's something going on that I just don't have a handle for, and I can't find it. Maybe I will as I'm digging through more and more of these stocks, but generally the type of outlook seems to be, we had a bad first quarter and we had a bad second quarter, and we'll probably have a bad third quarter, and hopefully things will be a little bit better by the fourth quarter, and I'm hoping by next year that everything will be all right and we'll be back to growing at 10%. And it does seem to be hope or just an expectation that actually I'm not quite sure what is going to happen next year, and so let's just assume we go back to where we were. And that's the part that's at stark odds to what all those forward surveys are saying. And so it might be something that pops up and we get this gift from the gods that suddenly we do get the growth, but I'm just struggling to see where it's coming from.
Well, Jason actually asked a very relevant question here, which I'll just take you to. So do you think AI is a good investment, or will it end up being a bubble which advances too fast and then crashes and then slowly progresses forward over time? And do you expect much carnage in this area in the short term? And what about the longer term? And thanks very much for the super chat. Greatly appreciated. It's a great question. So we've touched on AI previously, but what's your latest thinking there, and how that plays into this EPS story?
Yeah, I think AI is going to be great for productivity. I think there's a lot of uses. I mean, it's still early days for a lot of these things, though. I think it'd be very hard and we're certainly not seeing companies sort of laying lots of people off. But I do expect over the next 5 to 10 years that there'll just be fewer assistants needed. People will get these great productivity benefits, and a lot of this is not the fact that these AI techniques weren't available before. It's more that we're democratizing it and making it much easier for people to run different AI factors. And so I think that I think there's some great productivity gains. And that's that second half of the question is, we'll see those gains later on. And then the question comes back to where's it going to accumulate to? So there's a few different places it can accumulate to. One is it can accumulate to the makers of these of the technology, so the software providers that are doing it. So OpenAI's and Google and all those. The issue with that is most of them are really in this land grab part. So you want to have, if I've only got 10 million users of my service and Google's got 100 million or a billion users on their service, then they're going to be generating much more insights from the customers who are typing in. And when people are clicking, you got it right, or no, you got it wrong, or regenerate this, they're going to be picking up more information. So at the moment, they basically all want to be giving this stuff away as cheaply as they can. And so, so do I think a bit like a browser or something like that, or some of these, the sort of advertising driven things. So I don't think all the value is going to accrue to those. They do have a few $20 a month ones, but that'll be, a subset of people will be getting those. Then you say, okay, is it all the hardware providers and the people actually providing the machines that are doing the calculations? Now, I think the hardware providers will make a fair bit of money, and so NVIDIA will benefit from it. But NVIDIA's already gone up by so much. It's hard to see how. Like I have to use some of my most aggressive assumptions about the growth of the market, and then I have to then assume that NVIDIA keeps like a 90 or a 95% market share in order to justify it. Now, maybe that'll happen, but it's already priced in. So it's hard to see how you're going to make a lot of money from investing in NVIDIA unless the market just grows way faster than what I would expect, and NVIDIA keeps that massive market share. And on that front as well, it's worth trying to work out, how many companies will we have that genuinely need to spend, millions and hundreds of millions of dollars on on generating AI. So I do get that this stuff is computationally very expensive, but I do think there also will be people who are willing to use other people's model, a Google model or an OpenAI model or something like that to do a lot of the sort of a lot of the underlying processing, and then spend a lot less to have it focused on their particular data sets. Okay, so do I think the people that are producing the equipment are going to get all the gains? No, I don't. I think they're going to get reasonable gains, but I don't think they're going to get the other lion's share of it. And then you come back to where the next part it can go is maybe it ends up in lower prices. So maybe what that means is that if you are if you're Coles or Woolworths or someone like that, and you don't need as many people working the checkouts because your AI is getting much better and it can pick up people shoplifting and and all these self-service checkouts and or it can predict more about what products you're going to need, and so you're more efficient on your logistics. Do you end up getting much wider margins, or actually is everyone trying to do that same thing, and so you just end up with fewer staff and potentially lower costs? And so for some industries, that will be the case, and some it won't. So I think the more the greater the level of competition. So if we're talking about, say, the car industry or something like that, more efficient supply chains, I think that'll all end up getting competed away on price, and also the consumers benefit. For someone who's got oligopoly, effectively like a Coles and Woolies, maybe they end up grabbing a little bit more margin. And then the final place you can get it is the actual workers doing this. So if you've got, say we're talking about a lawyer you've got your senior guy charging $500 an hour, and he's got 2 or 3 juniors working for him, or her, earning a couple $100 an hour. Maybe they no longer need those helpers or as many of them, and so that lawyer can actually end up with a higher salary and take a greater share of the revenue. Keep charging the same rate and just not have as many assistants that he or she needs to pay. And so I think it's a whole mix of them. But and you pick your industry, and I think you'll see more in one and less in the other. Where are we seeing the big benefits at the moment? That NVIDIA, which is hardware, Alphabet, Amazon, Microsoft, that are doing a lot of the processing, and also have some of the AI stuff themselves. I think that a lot of that's already priced in, and a lot of that's already factored in. So yeah, net, I think it's going to be great. I just think it's over, in those 6 stocks, I don't know if it's completely overpriced, but it's certainly priced a fair bit of success already into it. And I think there's we'll see a trough of disillusionment before we see the real gains, and the real gains will be productivity ones for the whole society.
Yeah, well, I agree with you. I think there's a lot of hype in there at the moment, and I don't think that the technical companies are where the ultimate true value creation will be. It'll be when it's actually integrated into other businesses, and if they can do things differently. And one of the examples I would have is that if you've actually got the ability to use AI to guide and support decisions that would normally take a lot of people to do, and you can actually then reduce the number of not high quality experts, but the middle managers, the people who are sort of in the middle of organizations. So I have a theory that you're going to see a bit of a hollowing out in that sort of middle area of many organizations who are still people heavy. I think, for example, in the finance sector, we could see a lot of efficiency gains there potentially. But of course, the question is that also, well, if you have enough AI taking people's jobs, what is everybody else going to do? It goes back to this big question, right? How does it actually broadly impact society? And are less people going to be employed as a result of it?
And the fascinating thing for that is that if you asked me 5 years ago who was going to get hit first, I would have said it's self-driving. It's the drivers that are one of the largest employment groups in any country. Is that whole transport sector, and then probably some manufacturing jobs and things like that. What's interesting is it's actually all the white collar jobs. So the traditionally your blue collar or your high vis jobs would be the ones who'd be hardest hit. And I do think that's coming for that sector. And we should talk about that briefly in a second as well. But what's interesting is that the ones that are really on the chopping block at the moment are your journalists, as you said, your financial analysts, your middle managers, like these real white collar jobs that are that they're looking like they're going to get hit first. And so managing that from a society perspective is going to be really important. I think there's the US, I think, the US in particular did a poor job of managing that transition as they transitioned all their manufacturing jobs out of the US and into China. And I think that's given a rise to a lot of the political instability, in that people are genuinely angry that wages for a section of the economy has gone nowhere for a long period of time. And I think there's if you see over a 10-year period, say over the next 10 years, we lose most of the drivers that are out there. Like that is we will be in big political. We'll have some big political issues from demagogues and people who are standing up saying they've got all the solutions. And if we don't actually have transitions for these people and ways to try and get them into other jobs, and I don't see any of that. I don't see any of the early signs and sort of recognition of that as a problem. So the self-driving one. So Google, which sort of operates as Waymo, and then you've got Cruise, which is part of GM. So they're both running now live taxi services in San Francisco, which is a pretty difficult place in terms of narrow streets and all that type of stuff. So initially Google ran it in Austin, and which is sort of wide open streets and good weather and all this type of stuff like that, which it was great in terms of getting it up and running. But then the question was, well, can they actually do that now in more difficult cities? And so San Francisco is one of the more difficult ones, and they're both up and running. The early signs look pretty good. And so the issue for that is, will that go exponential at some point? And is it now at enough of a stage they can actually just start rolling out city after city? And if that's the case, there are a lot of driving jobs that are in lots of trouble. I was joking to you earlier. You had to run out to get an Amazon package that you had to sign for. Could you see it the case that the Amazon vehicle will pull up at your driveway, tell you to come out, type your code in, and pop open a box and you'll pull yours out? Absolutely. If that's where it's at. And the biggest cost, most Ubers in developed countries at least, of most Ubers is the driver. That's where most of your cost ends up. So if you end up cutting out 60% of your costs, 70% of your costs because you can do that, that is there's lots of things for it. It's, yes, a big problem for society, but the flip side as well is that it saves so much money for people to most people have this car that they use 5% of the time or less sitting in their driveway most of the day, and the average car costs people $10,000 a year in a mixture of depreciation and sort of running costs. And so you suddenly give a lot of people, even if it's just everyone's second car they didn't need, or a bunch of people who don't drive much, getting rid of their car and saving themselves $10,000 a year. That's a pretty big productivity gain for society.
Absolutely. Well, I think it's going to be interesting to see how it plays out. I suspect it's a bit like the internet. In the early days there was all this talk about massive this, massive that, and then it sort of tailed off a little bit and we had the .com bust. But the longer term implications of the internet and what we can do with it, I mean, this show would not be in existence without the internet. I think the longer term opportunity around AI is still to be determined. But I am quite concerned about the hallucinations that seem to be an intrinsic part of particularly regenerative AI. And I was talking to someone the other day who's quite expert in this, and he said, it's getting quite hard now to really actually decode what's going on, because the AI systems reference things and make references, but those references don't necessarily exist. So it's not just, they make up a fact. They actually cite a reference for a fact that doesn't exist too. Go figure.
Yeah, that's right. Look, there are definitely lots of issues with these types of things. And there's some that are better than others. So one of the ones I use, Silitus sort of actually is sort of more of a research tool, and it sort of generates it, but then it gives you all the sources, so you can actually go, okay, let me go verify a few of these and just make sure you're using stuff that's reasonable. And there's other ones that let you there's plugins you can get. It's like for ChatGPT, and you can say, okay, go and do this because you can understand language and all that type of stuff, but here's where the answers are. Don't make stuff up. The answers are all in this document or these web pages. Yes. They're your only source of the truth type thing. And so I guess the interesting one on that, though, is that for me is that some of these ones, there's some research papers out, or one in particular that I'd seen, which is basically talking about how the answers get worse the more other AI generated data you've got in there.
Yep.
And so if you think about this as like, if you think about AI, and people will complain about this, but as being sort of basically just like a big regression where you basically, I've got all my variables in there and I'm spitting out the other answer. The issue then is you say, well, if I keep, so I do this thing and I come up with this answer that says, here's 10 things that are important. And there's sort of like, they're all of like a 5% importance. And so it's like a 50-50 chance. And they're sort of, but they're the most important things. If I then go and generate lots of AI off that data, it will keep putting those 10 things that all had a 5% chance in there over and over and over again. And next thing you know, now there's now it's saying, oh, these things are guaranteed because, I've got 10,000 documents out there where there are a 5% chance. And now all these people have created all these AI text off that same data set and ended up just doing the most likely ones. And so you miss that. It's sort of ends up overstating how much that actually feeds into it. So yeah, there's absolutely problems. I have no doubt that, there will also be solutions to all these problems, and that I think it is. There's certainly stuff that looks really interesting when you first see it, and then you start digging in and using it in more detail, and you're like, actually, that doesn't work anywhere near as well as what, or it's just inconsistent. Like you ask it the same thing, and you get this great answer, and then you ask it exactly the same thing, 20 minutes later, and get this nonsense answer. And so, there's lots of stuff that needs to be done in terms of that. But it does look very, very interesting.
Yeah, and there's an interesting thing I was reading that there's an AI that's built off Van Gogh's correspondence, and you can actually ask this AI of Van Gogh, "What's your favourite painting?" Right, and in fact, you'll get different answers depending on, all sorts of things. It's sort of Starry, Starry Night, or it's the sunflowers, or whatever. And the people who were involved in building this said, well, that's just typical because that's what people would do. They wouldn't necessarily be consistent. And I'm thinking, well, hang on a moment. If we've got to the situation where we've actually got engineered inconsistency in answers, that gets you sort of to a rather awkward situation. And then the other point that you make, just to reiterate it, the idea of creating regenerative feedback. In other words, the more stuff that's created gets it back into the source and then contaminates the source. And so you get potentially further and further away from truth. So, you get to the point, well, what's real, what's not. And then if you actually overlay deep fakes and those sorts of things too, I mean, we're entering an era where nobody's quite clear about anything they're seeing. Are you a deep fake or are you real?
Exactly. Well, that's right. And then you start seeing, somebody was out. Well, anyway, there's lots of ones. Like I think there's a Tom Cruise one out there that a lot of people have pointed to, but there was another one out over the weekend there was I can't remember. There was a famous actor coming out saying there's an ad out for whatever it was, and this is definitely not me, and I'm not involved in that. Yeah. It looks like me, but it's not me.
Yeah.
And so, I think there's the truth is going to be harder and harder to distinguish. And so, that's that whole thing. Who are you going to believe, me or your lying eyes type thing is, might actually have more truth to it going forward. It's do you?
What is truth?
Yeah,
and then
are we fighting politics between who can come up with the craziest thing or the most believable thing that the opposition leader or the government might have done? That's just completely a deep fake, but people will look at it and believe it. So,
I know, makes an interesting question. Now, just before we come to the end of the show. This was an interesting question, which I thought you might be interested in pulling apart a bit. So, do you do ETFs and then pick individual stocks, or what's the process that you go through in terms of building these portfolios? And it's worth saying, of course, that Nucleus Wealth has a number of different portfolios and it's highly customizable. So, how does it play into the ETF and individual stock?
Yeah, sure. So let me talk about the two different types. So on one side, we've got the active, and I will leave that for the side because I think what you're really asking about is the direct indexing side, which is just like an exchange-traded fund, except what we're doing is we give access to the underlying securities. So what you do is you go through and you say, how many stocks you want? You want 75 stocks or 50 stocks or 40 stocks, whatever it is. You pick your effectively the same type of thing as you see in an index. Then you can knock stuff out that doesn't fit, and then you can add things in. So effectively what we're doing is saying, say an international portfolio, really common is you go, yep, I'll take the international portfolio. I'll have the top 75 stocks. I also want to knock out anything to do with whatever, gambling or climate change. And I want to add in some extra cybersecurity and maybe some extra cloud computing or nuclear power or whatever it is that sort of floats your boat, is you sort of can add that in. So it's effectively like an ETF, except you can customize it. So,
yeah, interesting. And I think that customization is something which it's really interesting, right? Because I've said on a few occasions, massive transparency, massive optionality to be able to do different things. So there are people who really don't want to spend too much time on individual things. They want to sort of set the direction and just go off and manage it for me. But there are other people who are very proactive and want to actually pick and choose and do some of that and do more of that and do less of that. And your platform actually, amazingly, can accommodate that complete continuum.
Both, yeah. And the things I know, like we call them tilts and screens, that a lot of them don't make a lot of difference to your overall portfolio in terms of performance. So, and you say, well, why do it? It's like, well, if you've got a parent who died of lung cancer and you don't want anything to do with tobacco, then it's really easy for you to cut out any tobacco stocks. And it might not make hardly any difference to your portfolio, but you can sort of, I guess, at least you can. You're not investing in things that that you feel morally against on one side, and the other side is if there's stuff you do genuinely want to have access to or you think is going to be industries of the future, you can sort of add them as tilts, and that goes from anywhere from saying I'm going to have stacks of that. Traditionally, what we'll do, like if you're going through some of our self-directed, we might give you like a 5% tilt. Extra weight to that, or a 10% extra weight, which will make a little bit of difference to performance, but is not going to be the difference between you sort of doubling and halving your performance. The flip side is if you want to do it all yourself, you can come through and say, just give me cyber stocks or just give me cyber stocks and nuclear power or whatever it is that you want. But there's over 100 different screens and tilts we've got that you can choose from.
Yeah, very good. And Cookie Boy just threw this in. Thanks for the super chat, Cookie. Thanks for the epic chat. Rate cuts in 24, 25, or 26? What do you think, Damien?
Yeah, I think by 26 we're back to rate rises. I think we're. Yeah, look, I'm. Look, to me, I think we're getting close to. I mean, it's hard to say when it's coming. It's obviously been extended longer, and I look at different analysis of what's really driven inflation lower, And a lot of the analysis, or certainly a number of different pieces I've read recently, have talked about saying, well, actually, if we look at the things that are really affected by interest rates, that's not what's bringing inflation down. A lot of the inflation stuff is literally just the supply chain and other stuff that sort of got, it ran up and now it's running back down again. And so if that's the case, and the interest rate stuff is really starting to bite. We're getting close to 18 months in, but most of the rises we're still only 12 months into where the sort of bulk of them occurred. If we're going to keep seeing that for another year or two, then I do think we'll we'll see a significant downturn. Is certainly my base case. Is that it will be large and significant, and if central banks keep holding rates for too high for too long, then the deeper it'll get.
Well, I think I may have told you I've got these three scenarios. The first scenario is that we manage to avoid a recession here and overseas, and in that scenario, I suspect rates will be as high as they are now into 2025, and then maybe start to drift down. But there's a much more likely scenario, which is that we get a more significant recessionary event either in Australia or in the US or elsewhere. And in that case, rates will come down sooner. But as you said earlier on, if rate cuts come down because of the fact that we've got a recession, that's not good news, because that means that we've got bigger problems to deal with. And
especially for equities.
Yeah,
that's right. And if you're looking at stocks and you're saying, well, I can get a 2% yield globally and I can get a 4% yield on Australian stocks, and you're like, well, yeah, but you can get 5 on bonds almost, so and locked in. You get better yields on government bonds, which are effectively risk free, locked in, and stocks. You got a question about growth and all these other factors that go into it, but we've been through a pretty good profit cycle, and there's some really hefty numbers forecast into stocks that, as I said, I'm still trying to work out why. We get a bit of disappointment there, and they're very much priced. Stocks are very much priced for perfection at the moment. So if we don't get perfection, they'll be lower. So.
Absolutely. Well, a lot of uncertainty. Damien, thank you very much for spending some time with us this evening and taking us through some of those really interesting areas. Some deep dives on some really important subjects. So thank you very much for that. We've put links and things below if people want to find out more about what the Wealth Funds and Nucleus Wealth. A lot of people are finding it complex to try and navigate, and this is a way of perhaps helping to navigate the rather choppy waters that we're in at the minute. And I don't think it's going to get easier anytime soon.
They're looking like they'll be choppy for some time. Yes.
Well, thank you very much. I'm going to take you offline, and I'll look forward to doing it all again next month, because we make this a bit of a regular go. So thank you very much, and we'll close the show in a second. See you, Damien.
Thanks. See you.
So there you are, folks. Hope you found that entertaining and useful. Some very important messages there, I think, too. Just to say that next week I'll be on myself, just talking about the latest household financial stress modelling analysis, and means you can ask some questions specifically about postcodes if that's something you're interested in. And just before I go, I will show you that the old doggies are still flat out. I don't know what to say about those dogs other than they have a very nice life. So I think next time I'll come back as a dog. Anyway, thank you very much for spending some time with me this evening, and thanks very much for the super chats. Greatly appreciated. We'll see you next time. This is Martin North from Digital Finance Analytics, signing off. Cheerio.